Welcome, I'm Catherine Magaña here with Greg Carroll, Steve Wolff, and Vince Stefano, where we're here to provide you insights about the markets and planning and much more. But before we get started, I wanted to share an event we have coming up next week. It's actually here locally in Carlsbad. We're having it at Hera Hub, and it's called Health, Wealth, and Legacy, and it's a half-day retreat where we're going to be having different speakers. We have Dr. Mana joining us, Rachel, myself, and Geeta Nasiri. Along with this, we also have Charla, who's going to be doing some meditations. And so we're really excited. It's a full afternoon of collaborating and coming together. So if you have an opportunity, please register and let us know if you can join us. But let's go ahead and dig in on kind of what's going on this week. So here we are. Today is October 30th, and we had the rate cut that came in yesterday at 25 basis points. We have earnings that are coming in. I'm sure Vince will touch on that, but it looks like we've had some pretty good earnings. A couple ones not so good, but for the most part, it sounds like they've been good. We're still dealing with a government shutdown. So here we are, day 30. So
is it 30 days?
Yeah, it's 30 days as of today.
I guess I don't even think about it.
And there's still kind of a lot going on. And then looking at from last week to this week with the markets, the biggest mover is the NASDAQ, which is more of the tech and AI stocks. And year to date, it's up 24%. And from last week to this week, it's up over 6%. And the Dow Jones was up from last week to this week. So we're at about 11.96 as of yesterday's close, which was October 29th. The S&P right now we're at 17.15, and the Russell 2000, which are the small stocks, it's up from last week a little bit, about 11.42. So obviously we've had some pretty good run-up investment-wise. I think the markets are up a little bit. Well, it's kind of mixed today. The Dow is up and the S&P and NASDAQ are down today. But for the most part, we've had a pretty decent run-up in the markets year to date. And kind of talking about the Fed rate cut. So that came in yesterday. They said the 25 basis point cut. But then we heard some indications that potentially, the December rate cut, it's not a shoe on that we're sure it's
not
going to happen.
Not on a preset course.
Yes. And so
do you have a percentage on that?
I do. So it went from 90% to 68%.
Ooh.
So we'll see what happens. I mean, I think that's already been priced into the markets. So I think the markets were a little jittery on that news. And so that's kind of where we're at. Kind of some of the big headlines still kind of similar. Some of the things are the same, but we're now getting indication between now and the end of the year where we're going to be with certain items.
Well, markets have gone up very nicely, and recently it's kind of interesting. Retail investors have been a driving force in the trading volume, and a big part of that is the FOMO effect. I mean, a lot of these retail clients, fear of missing out. As I've been pounding the table, when the Fed starts cutting rates, people move. Investment capital flows to risk assets, i.e. the stock market, and the stock market's been doing incredibly well over the last 6 to 7 months. But more importantly, I think a lot of retail investors are finally looking around and saying, hey, if the Fed keeps cutting rates, I got to get out of these low-yielding money funds. In fact, even one of our retail guys this morning on a conference call, was talking about, the fact that as these money funds start coming down, people look to, higher yielding funds, and, he may be one of them. But Catherine talked about earnings, and let me just mention this real quickly. Q3 earnings have come in pretty good, and it's really fueling some big moves in the stock prices and in the stock market. Most companies have done much better, top and bottom line. All said, spending has done well. More importantly, guidance is quite positive. Yesterday, 3 mega cap stocks reported earnings. 2 of the 3 haven't done well today. Interestingly enough, all 3 beat consensus expectations. But a lot of times expectations are very high. And it's that buy on rumors, sell on news. But people were trying to figure out a reason to maybe take a little off the table on some of these companies. And what they did find was that some of these companies have guided 2026 spending a little higher. So they feel that
I think
they
one of
might
them said substantially
higher. But, that's good and bad. I mean, good because they want to expand their business and they think that that's going to really help in the future. Bad in the short term is that it puts pressure on some of the earnings. So, I'm a firm believer in, hey, companies understand what they want to do over the long term. And if these companies are spending money, that's a good thing. Another really interesting under-the-radar market-moving event that I've seen the last really month, a large number of companies in a variety of industries have been announcing new partnerships and collaborations with large cap tech firms. And I'm talking everything from energy to retail to consulting to food service companies. What they're doing is they're partnering up to advance their own AI platforms to generate a lot of increased revenue going forward. And this is having an incredible positive bias on the market. So I think that there's a lot of very interesting things going on right now as we get through this third quarter earnings reports. But as I've said, and I've been pounding the table, the market right now, the bias is to the upside. And you've got to be in it because that's where the big money is going to be made right now. It's not going to be made in the money funds. And I know, Steve, you're saying, well, if you're 85 years old, but not everybody we talk to is 85 years old. So if you're 28...
Most of your friends are.
28, if you're 28, 68, 88, you've got to have a good amount of money in some of these equities because for the next 18 months to 2 years, the stock market, I think, is going to do incredibly well.
Yeah, and so just to tell you that we're not saying that you shouldn't have any in the stock market. We're saying you shouldn't have all.
Well,
in the
I'm not
stock
saying
market.
you should have all in, but I've been pounding the table now for 7 months telling people, get out of some of these low-yielding money funds and move it into the market. Last thing I'm going to say is with some of these mega-cap stocks, if you own them, even though they sold off, you're in good shape, don't sell. If you don't own them, any kind of pullback, I would be a buyer.
So let's talk a little bit about some of the good and bad that's going on in the market, maybe some risks and some rewards that might be there. First of all, there is an unusually high concentration with the top 10 stocks in the S&P 500. Mm-hmm. It's something like nearly 40% of the index's market capital weight is in 10 stocks. So if those 10 stocks move one way or the other, they move markets. And that's one of the reasons why the S&P and the NASDAQ are doing so well is because you've got this concentration of stocks which makes up a great majority of or a great minority of the index. And in the NASDAQ, it may be even a majority, I'm not sure. So that moves it both ways, all right? So for those people who ask all the time, well, don't you think this market's overvalued? If you're nervous, you can take some of it off the table. It's okay to ring the cash register once in a while and maybe look at some dividend stocks. That might be appropriate. You get dividends along the way, and those they've done well. They haven't done as well as the tech stocks for the most part, unless, of course, they are tech stocks that are paying dividends. But that's one. The other thing is tariffs are still a risk. But as we can see what's happening with China, China said they were going to maybe not give us some of those rare earth metals. And Trump said, fine, we're going to give you a tariff of 150%. Well, neither of those two things are good. So there are some risks. However, we saw the Fed give a 0.25% rate cut, and that is usually a tailwind to the stock market, as you just alluded to, Vince. So that could be an offsetting factor.
Well, if you look at what the market's done since Liberation Day in April, what's the market up?
So it depends on which index. So the
Well,
S&P
the
500,
S&P 500?
It's up 17%.
Year to date, but from the low, it's probably
yeah.
closer to 30.
Yeah.
So tariffs, I don't think are a big risk. They move markets in a very short period of time, but look at what the market's done since we thought tariffs would be such a bad thing.
Well, tariffs are adding on a little bit to the cost of living.
They are.
We have to
it's hurting the lower end.
Right, exactly.
Consumer.
It is.
Yeah.
So that's where there might be some risk. The other thing is companies are reporting strong earnings, which you just talked about, and really good earnings.
Mm-hmm.
Which in some respects is a little bit of surprise. But on the other side, and we're not really talking a lot about this, but consumer debt is growing. and it's growing at a pretty major clip. And I think that's because when you talk about the lower end of the economic scale, they are being affected by the tariffs, by increase in costs of goods. And the other thing that nobody seems to be talking about is there are large company bankruptcies which are going on now. And I just heard something, I think it was on, I don't know, yesterday, the day before. I think the number was like 446 large companies have gone bankrupt this year. That's an unusually high number.
Do you know what kind of industries they're in?
I don't.
Okay.
That's just what I heard.
I was kind of curious. Okay.
I would assume that's not large.
No, large companies.
Large companies.
Yes.
Defined by what?
I just heard this on radio. I don't have any more than that.
Okay.
They said that about 446 large companies.
Was that an AI radio station you were listening to? Or?
As I saw yesterday, they were saying that there's some big companies, I'm not going to define which are big, but are cutting some of their staff and revisiting their AI and some. So I think it's definitely changing. But I also think a lot of companies overhired potentially too, overstaffed. So it'd be interesting to see how that falls out.
But I think that this bankruptcy thing is something that we haven't talked about. And it's something to look at. And if you want, I'll try to get more detail on it, maybe for the next time if I can find it. But I, that's a little bit disconcerting.
Well, I think another big thing that, you hear a little bit about in the news, and the reason why the Fed lowered rates yesterday and why they're probably still going to do it in December is unemployment is becoming a problem. You know what the unemployment rate is for 20 to 24-year-olds?
Oh, it's pretty high, isn't it?
30%?
Wow.
Well, I think we'd be in a lot of trouble if it was that high. But it's like over 9. I mean, that's pretty high.
I
If
was
we
just taking a guess.
Yeah, that's Depression era type stuff. But over 9%. I mean, you're coming out, this generation coming out of college is not finding jobs. And I think a lot of it might be with AI and this new, how AI is disrupting, jobs. I mean, who is it? Amazon's laying off, thousands of white-collar workers.
And they just had good earnings.
They had good earnings, yeah. So I think the unemployment picture is really, and I know Powell I don't think he touched on it as much as maybe he should have or could have yesterday, but I think that's what's going to drive the December rate cut. Unemployment.
Well, so you think that we're still going to get more rate drops?
I do. Yeah, I would say it's more than 68% or whatever.
I agree with you on that one.
I just don't know if they're going to do it. Now, I originally thought they were going to do it December, but I don't know. I mean, I think they'll do it. I just don't know how quickly.
I think they're going to do it in December, would be my guess.
And then going
willing
back
to take all bets.
Yeah. Wait. And then going back to the tariffs, I mean, the first part of the year, I mean, we were whipsawed and it was very, volatile with the markets. And I think since then there's been some negotiations. I know China and the U.S. came up with some new deals. And so it's just one of these things. I think we're starting to normalize that a little bit and know that this is part of business. And but I think in the beginning of the year was definitely, it was a lot of change very quickly. And so I think we're now, we're not hearing as much about it, but definitely I think it has been priced into.
We still have to remember tariffs are an extra cost.
Yeah.
So the companies have to make more money to cover the tariffs,
right?
Which usually causes inflation, which is one of the reasons why I don't like tariffs. But on either side, and we're being tariffed to death by other countries. So I guess Trump's his reason for doing it is that, hey, if you're going to do that, we're going to do it to you. But I still don't see that it's in the same proportion. Mm-hmm. It's kind of, well, we're going to do this to you, we're going to do that to you. There's still a risk there with tariffs, I believe.
Yeah. I think all these tariff threats, and it's mushy out there,
Mushy.
There's a lot of threats.
I believe that's a new economic
Well, I do know that a lot of the retailers have been hurting recently because tariffs have caused some prices to go up. They've had to raise their prices to compensate for some of the tariffs. And so, unfortunately, you're seeing some, really good retail companies start to suffer a little bit. Now, how long is that going to last? I don't know. Is it going to, change during the holiday season? Will Black Friday bail everybody out?
It's interesting. I was listening to or reading something about what Jamie Dimon, the head of J.P. Morgan, was saying. And, of course, he's been wrong about every prediction recently. But, he thinks that there's more of a chance for a market crash. Now, maybe not immediately. And then, it was funny.
When you say crash is a strong word.
Yeah.
I'm telling you what he said.
Yeah. He said the word crash.
He did. And I'll have to, again, go back and get that info. But what he said was, I was thinking, in what time frame? And then the article who reported this said he was talking about in the next year or two.
Yeah.
Well, a lot can happen in the next 2 years
Yeah.
if that's the case.
Right.
So, but listen, whenever anything goes straight up, and some of these companies have gone straight up, it doesn't stay straight up.
Been some amazing returns this year.
And you have to remember, bull markets end when there's a negative standard deviation event that hits, the
Yeah,
market.
but
So
a lot of times-
until then, this market's going to continue having a strong bias to the upside.
I agree with that, but a lot of times we don't know when that's going to
That's
happen
true.
or what
Yeah.
it is.
Oh, yeah.
So
Yeah.
something could happen tomorrow.
Absolutely.
And we don't know. It
But-
comes out of nowhere.
But that's what I'm saying. It
comes out of left field, kind of like Toronto beating the Dodgers.
yeah.
Yeah, but like I say, typically it's a standard deviation event that has to that ends a bull market, and I don't see that in the future right now.
Was that an 18-inning game last night? Or was
Not last night. That was a
Just
couple
kidding.
nights
That
ago.
was-
Standard 9.
I don't know if I could handle 18 innings. That's a lot.
I think they said it was like 8 hours or some crazy number.
yeah.
Oh,
Yeah, it was. I think it was 8.5 hours or something.
And they stopped selling beer, I think, after the 7th inning.
Oh,
Those
really?
people probably were killing, they were
that's
dying out there.
Yeah. I went to bed when they ended the 15th. I'm like, I'm done.
Yeah. So a few other things. Looks like mortgage rates as of October 30th, it's 6.19%, and the 15-year rate is 5.54. So those have come down a little bit. It was interesting. This morning I did hear a real estate market update from Kim Lombardi. She works at Coldwell Banker here in Carlsbad. She did give a little bit of an update kind of across the U.S., and it looks like on the West Coast, which we're seeing a little bit of a softening with real estate prices. And then on the East Coast, the Northeast actually had gains, and then the Southeast was actually down, which is kind of, I thought, well, I didn't realize what the impact is. But these are projections they're looking at for next year, that potentially that real estate values could come down a little bit next year. So we'll see. I mean, we are seeing it already, especially as interest rates are changing. They're also saying now it's kind of shifting from a seller's market to more of a balanced market, and then with more of a buyer's market. So, there's, as we're looking at financial planning and investing, we do factor in real estate and some rental properties as part of your financial plan. So we like to make sure we stay up to date on that as well. Or if you have any questions on how this fits in with your plan, we're happy to look at that with you.
Well, I'm hearing that with the lowering of rates, the mortgage rate, that there are some people now coming out of the woodwork and starting to put in bids for homes.
Yeah.
So that there was virtually, well, I shouldn't say virtually none, but very little in that regard for a while, because rates had gotten pretty high pretty fast. And now it seems like, you can get lower than that 6.1%.
You can buy down your rates, too.
You can buy down.
Yeah.
Plus, I think when you go through a direct lender, I think that you get a little bit lower rate. So it's not unusual now to be in the 5s. And 5s versus 7s is a big difference.
Yeah, that's a game changer.
That's a big, it's a big difference.
And then another thing that came out recently is the 2026 Social Security Administration confirmed that the cost of living for next year is going to be 2.8%. So at least we kind of know what those numbers are going to be. And then I was looking at inflation right now. Inflation as of September, it came out at 3%. So it's a little below inflation, but inflation actually was up slightly from August to September. So that's kind of where we're at right now with some of those rates.
So do you think the government's ever going to open up again?
What's the longest shutdown?
This is it, I think.
I think
I don't think we're quite there. They said we probably will be shut down for another week, and that puts us into that category.
What category?
The longest.
Yeah.
I thought it was already, but I don't know. I don't know. But
Check with your AI. See what it says.
I will. But it's been a long time. Who I feel sorry for are the people like the military
it's
who aren't
ridiculous.
getting paid.
Yeah.
And I heard that some billionaire, and I forgot who it was, has given money to the Pentagon to pay for some of these people.
Really?
Yes, and I just read that, and I wish I could remember who it was.
They didn't say, but it was 135 million.
Million.
Yeah, the billionaire gave $135 million to pay military salaries.
Right.
So that's kind of cool.
Yeah.
So, well, yeah. So, it's funny, too, because I also heard yesterday that somebody in Congress was floating the idea that there should be a constitutional amendment that says when you shut down the government, you don't get paid, the Congress people.
Why in the world would those people get paid and not the people protecting our country? That is the most ridiculous thing.
I don't think any of them. I don't think any of them get paid right now.
No, Congress does. They get a check every week.
You sure on that?
Yes, 100%.
Okay.
100%.
Congress gets paid.
But eventually everybody gets paid anyway because you have back pay. But I think that Congress should absolutely not get paid if you're going to shut the government down.
Right. I actually heard something this morning that said not all contractors are made whole after the government reopens. So not everybody always gets paid, and there's been a lot of talk.
No,
and
but
if you're one of these people not getting paid right now and you hear stuff in the news that says, oh, well, maybe you won't get your back pay, I mean, that should be a non-question. They should be paid, first of all, like Congress.
Right, but military and government workers will all get paid at some point. It's just they're not getting it now. So, and again, it's unconscionable to me. It's the same thing that, you pass the Obamacare thing, but Congress isn't under it. The rules should apply to them as
100%.
well as everybody else.
Yeah. I'm just curious, if some billionaire gave $135 million to pay the military, but nobody's actually working to pay that money out.
That's the government for you.
Money's just sitting in a money market right now.
Well, remember, things are still being paid out. Social Security is still being paid, et cetera, et cetera.
Yeah.
So I guess that could be worse.
Yes.
And speaking of billionaires, I read something today in the Wall Street Journal that the stock market over the past 2 years has created a number of billionaires because of the concentration of wealth that is made in the stock market. Well, the interesting aspect of this, 45% of the billionaires are in the United States. Mm-hmm. So they are reaping the benefits of a very good upward stock market because, a lot of it is the common names that we know.
Apparently, the people in New York City haven't found that out yet because they still like the socialist who's running.
All I'm saying, this is what I read in the journal. It's kind of interesting that 45% of the world's billionaires are in the United States because of our stock market and how it's done over the past few years.
That doesn't surprise me. I actually would have thought it might be higher.
I did too. But again, so that kind of leads me to say, get into the market because if you want to make money, you got to be in the big casino.
Things are not cheap out there.
I was like, usually we have a plan. It's not a casino.
Well, that's just.
I'm just playing.
People like to joke. It's the big casino.
I know.
Yeah.
Actually, who says that a lot?
Probably
Gasparelli.
Caesars.
Was it Gasparino, the guy on Fox Business? Charlie Gasparino.
Oh.
He always said, the big casino.
Yeah, the only difference is that in this casino, over time you win.
Yeah.
In the real casinos, over time you lose.
Well,
So, or at least that's the way.
Over time, almost all the time.
Anyway.
Well, you could be a winner for a while,
for an hour,
right? In a real casino, but in the stock market, if you're in a good diversified portfolio over years, you made money.
Yes.
That's why I always kind of scratch my head at these people say I can't make money in the stock market when the return over the last 100 years is something like 9 or 10 or 11%.
They get emotional and they get out when things go down, and they get back in at the top with the FOMO, and it happens time and time again. We've been in this business long enough. We can kind of tell which clients are going to call, when the market's going down, and we know which ones are going to call near a top, and it just happens.
Yep. Human emotion.
All right.
So as we wrap up, just an update for kind of our weekly short-term fixed income. There wasn't much change. So right now, our one-year CDs is 3.6, and our one-year Treasuries is a little higher at 3.75. 3-month CD is at 3.9, and a 3-month Treasury is at 3.88. So,
and Vince said he's going to put all his money in the CDs, right?
Absolutely. Casino.
Absolutely. I'm cashing my chips out of the casino. No, 3.9, I guess, isn't bad, but if inflation's at 3%, then it'll leave you 0.9, and then you pay your taxes.
Then you're underwater.
Then you pay your taxes and you pay your advisor, and you're underwater on that deal. So,
well, we always say that those really aren't investments.
They're more of a short term.
It's a short term. It's a savings. Temporary
parking.
Temporary parking.
And sometimes clients, they put it in there, and then when it comes due, they put money to work. It's one of those things that it's not long term.
Right.
But one of the things, I don't know if you had a chance to look at the fear and greed, but it looks like this week it's at 42. So
it's moving up more.
Yeah. I was like, that was
There you go.
Yeah.
Well, maybe it's because interest rates are coming down.
Yeah.
You know, again, that is still a tailwind to the market.
Yeah.
So there are risks for sure, you know, but there's been pretty good rewards. And I do agree with what Vince is saying as far as technology is concerned. I mean, this is like the invention of electricity. You know, seriously, AI is it's going to change everything. And that's what electricity did. So to not be in it for the long run, I think, is a mistake. But, you know, just like any market, you know, it'll have its ups and downs. And if you get into it right now, who knows? It could go down a little bit, but if it does, and
Buy more.
Yeah, you probably should.
Average down, but you know, like I said earlier, you know, all these companies about AI, whether it's energy or whatever, these different sectors are now collaborating with these big tech AI companies to enhance their own platforms.
Yeah,
and that's what we've been talking about.
Yeah, we've talked about this before,
time.
that it's not anymore just the people who make the chips.
Right.
It's how are you going to use it?
Yeah.
That's really going to be the next big winner over the next 5 or 10 years. So for the last 5 or 10 years, if you were in the chip companies, you've made a lot of money and you stayed in there. You know, and they'll still do well. But it's hard for me to believe that, you know, a company that was just up 10,000% is going to be up another 10,000%. That's just not going to happen, right?
Probably not.
So you have to kind of, if that's what you're looking for, you kind of have to look into some other parts to get that. But still not. I wouldn't sell off the stuff that's working.
Not at all.
So
Sell your losers, keep your winners.
By the way, HeraHub. Do you know where that's located?
Yes.
Because this is where this meeting is going to happen, which you led off with.
It's HeraHub at 5938 Priestley Drive, Suite 103 in Carlsbad. And so we are hosting the event there. They actually have a really we went and I toured the space last week, and it's very open space, and it was nice. I'm looking forward to hosting it there.
And what's the agenda?
So it's health, wealth, and legacy. So we have Dr. Mana, who's going to do the health segment. Geeta Nassiri is going to do estate planning, and then Rachel and myself will be doing the wealth. So we're going to there's a lot of exercises together. And in addition to that, we also have we have Charla Fagan, who's going to be our MC, and she's going to do some meditations and intentions in between. We're going to have some healthy snacks and drinks, and so it should be fun. It's going to be we're making it a little more interactive, and so if you'd like to register, you know, please let us know. You can register at savvyup.com/health wealth legacy.
Is this women only, or?
You're welcome to join us. Men are welcome, but most of those are joining us are women.
Okay.
But we don't want to
just want the audience.
We
You
don't
want
want
to
to
discourage
Discriminating against money.
But yeah, it is more women focused.
oriented.
Yes.
All right, and that's coming up again when?
That's going to be on November 6th from 2 to 6.
All right. So hopefully you get a lot of people who sign up for that. It sounds really, really interesting. And let's see what happens over the next week. Rates have come down a little bit more, and earnings are still coming in, and they're still coming in pretty well. So, you know, we'll see what happens by this time next week. Meantime, everybody have a good week and happy investing.
Thank you.
And happy, what's tomorrow? Oh, tomorrow's Halloween. Yes, happy Halloween, all.
Please stay tuned for important disclosures. The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional. WWM Financial is a registered investment advisor with the SEC.